Okay, welcome back, all fucking three of you, to the channel, to the vlog, to the fucking book club. All right, so of course we're continuing on the same book, and we're picking up right where we left off. So that would be, I think it's chapter 6. Yep, charting and patterns. All right, that's where we're picking up. All right, here we go. So other chart types. All right, there are other types of charts that may be useful at certain times. Although day traders do not commonly use them, these charts can provide insights in certain situations, particularly when analyzing opportunities from multiple angles. Many of these charts are exceptionally good at filtering out noise by removing time from the equation and focusing exclusively on price changes and trends occurring over time. Figure 4 is an example of a point and figure chart. It may look odd to those who are not familiar with it, but it can prove extremely useful in deciphering key trends. All right, hopefully that was visible enough. Some exotic charts types worth knowing are point and figure charts. These charts consist of columns of X's, and O's representing rising and falling prices, respectively. Unlike traditional charts, P and F charts don't plot prices over time, but rather price changes with each new volume representing a new trend. The purpose of these charts is to filter the noise and volatility in order to discern both trends as well as important support and resistance levels. Renko charts. Renko charts are similar to P and F charts in that they take price change into account rather than time. But instead of X's and O's, they utilize blocks and represent fixed price moves. The benefits of these charts are similar to the benefits of P and F charts in that they filter out noise to make trends and keep price levels easier to recognize than when using traditional charts. Heikin-Ashi charts. Hopefully that's the way you pronounce that. All right, these charts look at 2 time periods instead of 1 and calculate an average in order to smooth out price trends. Since they do not provide specific prices, they aren't all that useful for day traders except for identifying long-term trends in order to ensure they are trading alongside the prevailing trend. Traders have a number of choices when it comes to chart types, but the best option depends on the given situation. For instance, a day trader looking at a dense amount of past data for long-term trends may prefer a line chart to remove the noise, while a day trader looking at a 1-minute chart may prefer candlestick charts for the added information benefits they provide. Price scales. Most charts are created by displaying prices on the y-axis and time on the x-axis to show movement of an asset's price over time. While this concept may seem pretty straightforward, there are actually 2 different ways that prices along the y-axis are structured that can have a significant impact when analyzing a chart. Novice traders should familiarize themselves with these 2 price scales in order to avoid problems during analysis. The 2 different price scales are linear, when prices along the y-axis are equally spaced apart, with each space representing an absolute change in the stock price, then the chart is known as linear. The easiest way to know if a chart is linear is to look at the spacing between prices to check if they are approximately equally spaced apart from each other. Logarithmic. When prices along the y-axis are spaced apart so that spaces represent a percentage change in the stock price, then the chart is known as logarithmic. The easiest way to know if a chart is logarithmic is to look for the spacing between higher prices to decrease, since there is no less of a percentage change. The logarithmic price scale is widely preferred in the financial markets, since it better reflects change in value over time. For example, a stock that has increased 10% per year over the past 20 years will have a chart showing slow growth early on and then rapid growth later on. The reality of the situation is that the growth has remained constant, which is reflected in logarithmic chart that would show a fairly straight upward sloping line. All right, quick recap. Day traders rely on charts to provide instant insights that support their trading decisions. There are many different types of charts to consider. Both charts and candlestick chart, both bar charts and candlestick charts are the two most commonly used charts in the market. Bar charts provide insight into price action that distinguishes between the open, high, low, and close, while enabling day traders to look at a greater number of periods in a single chart than crowded candlestick charts do. Candlestick charts provide the greatest amount of information in a single chart with open, high, low, close, and directional information. The chart is only useful for shorter time frames, even though there are many different types of candlestick analysis. Candlestick patterns such as bullish, engulfing, or doji stars are great tools for determining short-term entry and exit points in the context of longer-term patterns or price movements. Nonetheless, traders should always look for confirmations. Day traders should familiarize themselves with the many types of charts with the many other types of chart available in order to maximize their competitive edge, including point and figure charts, Renko charts, Heikin Ashi charts, and a number of others. All right, chapter 7, technical analysis. So suppose that you were asked to estimate the populating growth for a city over the next 5 years given the historical trends over time in order to support a public works project. While determining the exact number of citizens may be more difficult than winning the lottery, relatively straightforward statistics provide a way to quickly and easily forecast the likely population in 5 years. The estimate may not be perfect, but it is likely to be a lot closer than simply guessing, and it's probably good enough to begin work on a project. Technical analysis is the use of statistics to predict where asset prices are likely to be over the coming minutes, days, months, or years. Just as you projected population growth in a way that's better than guessing, day traders use technical analysis to improve the likelihood of success for their day trades by taking bets that are better than 50-50. The idea is that making money more than 50% of the time will yield long-term profits, everything else being equal. When combined with proper money management techniques that lead to bigger wins and smaller losses, these dynamics can help generate a significant edge in the market. In this section, we'll take a look at technical analysis and see how it's used to improve risk-adjusted returns for traders and investors in the financial markets. All right, technical versus fundamental analysis. The debate between technical and fundamental analysis is nearly as old as the stock market itself, and there's really no true answer to who's right. Technical analysts argue that the company's fundamentals are irrelevant since the stock price reflects all available public information. In addition, they believe that prices move through interchanging periods of randomness, sideways trading, and predictability, trending prices. The economics of supply and demand, coupled with the underlying psychology of the market, forms this basis for these dynamics. While these predictions may not come true 100% of the time, the better than random odds creates an opportunity for technical traders. Fundamental analysts believe that a market's fundamentals drive prices, with everything in between being random noise. On the one hand, value investors look for companies that are relatively undervalued compared to their peers on their book value. The idea is that the valuation discount will be closed over time as the market realizes it exists. On the other hand, some fundamental investors believe the markets are efficient and that randomly picking stocks will produce just as much return as hand-selecting stocks in a portfolio. Others believe in a combination of technical and fundamental analysis in order to achieve the best results. Under this approach, a trader may use fundamental analysis to identify a stock that is undervalued and then use technical analysis to determine an ideal time to buy when the market is beginning to uncover the true value of the company. Many day traders fall under this category in that they believe fundamental information can influence prices, while technical factors prove entry and exit points that enhance the odds of success. Technical analysis basics. Charles Dow's Dow theory set the stage for the technical analysis nearly 100 years ago in a series of editorials published in financial papers. Among other things, the theory states that an asset's price discounts everything. Price movements movements aren't totally random, and what is happening is much more important than why it's happening. These core theories pave the way to concepts like trending and the idea that statistics can be used to predict price. Technical analysis is the forecasting of future price movements based on the analysis of past price movements. Whether looking for the market's mood or using statistical analysis, these techniques provide a day trader with an idea of what's to come, but not any certainty as to where prices may be headed. A good comparison is predicting the weather, which is generally accurate using various forms of analysis, but can be very wrong in many cases too. There are two primary forms of technical analysis: chart patterns and technical indicators or overlays. Chart patterns, day traders may look at patterns in past prices to get a pulse on the market's underlying psychology in order to make future predictions. For example, an ascending triangle pattern is an indication that bulls are trying to push through a key resistance level, and any breakout from that level may be significant. Technical indicators or overlays. Day traders may use statistical analysis to determine the strength of price trends and predict either continuations or reversals. For example, moving averages can be used to determine whether prices are higher or lower than they have been over the past 50 or 200 days. These techniques can provide valuable insights if used properly, but there are many potential issues to consider. Analyzing chart patterns is a very subjective process that's often considered to be more of an art than a science. Technical indicators and overlays may be less subjective in many ways, although they may also point traders in the wrong direction sometimes, particularly if the market's underlying fundamentals change. When using technical analysis, it is important to keep the fundamentals of the market in mind in order to avoid any problems. A sudden fundamental change in economy or security may lead a stock to rise or fall rapidly. In that case, technical analysis can be used to determine how far the stock will rise or fall before reaching a new support or resistance. So that's kind of like right before we get into the details of everything, I think. Trends and trend lines. This is gonna be a juicy ass fucking... Okay, yeah, so the rest of this is going to get really detailed, so before the next read, because then when I go back to listen to these and just make sure like I picked up on everything, that'll make more sense to me because it'll all be grouped together. So for all three of you watching this, it'll be grouped together. It'll be better for all of us. All right, cool. So I will see you guys next time. Thank you for joining. See you guys next time for chapter 7.